Goldman Sachs announced earlier today that they lost money on
just one
trading day.
One trading day.
You know, I read all these stories. Morgan Stanley lost money on only a few trading days.
Bank of America
They're making money hand over fist. But Wall Street, the stocks haven't gone anywhere. Let's just have a quick look at these stocks. Can we have a look at the stocks? JR, there we go. Oh, that's Dow. Here's Goldman Sachs. Since the start of the year, they've basically gone nowhere.
Right, and I think the important thing, if you look at the stock, and what you can't see just from the price, is how do they trade relative to their book value, their net worth. In Goldman right now, $107 a share, it's still trading just 80% of book value. So what the market is saying to Goldman, and Morgan is even less than that, is saying, we don't believe in your ability to make enough money to cover your cost of capital.
Right.
And that's regardless. I mean, everyone likes to sort of focus on how many days did they lose or make money during the quarter, but that's meaningless.
It's meaningless. How come we always lead our stories with this if it's so meaningless?
Because everyone loves it. It's the fixation on you. Did you have the perfect,
perfect
game? And did you have
those guys on Wall
passing
Street,
ratio?
It's like one giant conspiracy on Wall Street. You see, that's why they never lose money on a trading day, right?
But what's important still is just, can the firms make money above their cost of capital on an ongoing basis? And the market still has big doubts about that.
Big doubts. Now let's talk about, Goldman also announced that if they were to suffer from a downgrade from Moody's or S&P, that they too would have additional calls on their capital.
They
would
said
also
they'd
lose
have
money.
additional collateral calls of about I think it was 2.1 or 2.3 billion, which actually isn't really much change from the end of the year.
Right.
Where we saw a bigger change was when Morgan Stanley came out with its quarterly securities filing, and it said that it would have to collateral calls of close to 10 billion. That was up from about 6.5 billion at the end of the year. When you're talking about the downgrade issue, and Moody's is out there right now saying it's likely to downgrade a raft of banks in the U.S. and Europe, the focus is on Morgan Stanley, because they're the one that Moody's has said we might downgrade them 3 notches.
Right.
There's a lot of debate within the market. Will they go 2 notches or 3 notches? 3 notches is really bad for them.
Morgan Stanley's stock has, after popping a little bit, it's back down under 16 bucks right now. The market is basically saying, if I'm an investor, I'm not going to wait around to see what Moody's does.
The market is saying 2 things. One, yeah, I don't want to wait around until this verdict comes in of 2 or 3 notches. And then I think what we're also seeing is, remember, think back last fall when Europe was on the boil. Morgan was one of the proxies for it. Last fall, it was if Europe was blowing up that day, Morgan was going down and Citi was going down. Still a little bit of that remains.
So
and
when you saw this, the Greek stories were passing around.
Right,
Morgan
so that was it wasn't
off.
just the ratings. That was weighing up, was also Europe. So I think you had those 2 things in tandem on them.
Now, tell me, I get the feeling, and I could be wrong, but I get the feeling like when it comes to Wall Street and the bank stocks, I feel like we're like running in place. Like all these uncertainties, it's all there, and we're talking about the same things over and over again. I mean, the go-go days, dynamic growth. I mean, the media's trying to kind of create some frenzy out of this Facebook IPO.
That's you.
Well, that's me. I'm going to throw everybody else in the media in this. I mean, the story here is regulatory uncertainty, Moody's uncertainty,
but I agree with you on those 2 things, but the bigger thing but I think the running in place is a great metaphor. The bigger thing is just the global economic headwind. If the economy isn't growing strongly, if credit isn't expanding, and especially if you have a super low interest rate environment, and with all the uncertainty, people aren't trading, that just weighs on the bank results. They've got this enormous headwind. So even if you took away the regulatory stuff, they're still going to be fighting that wind.
Okay, final question. Is there any reason to be particularly bullish about any of the U.S. banks in terms of stocks, or the Wall Street banks, Goldman Sachs, Morgan Stanley in particular?
I think there's reason to be bullish on some of the regionals, or someone like U.S. Bank, which has been seeing really strong business lending growth. And if you start to see firming in the mortgage market, well, then a lot of those banks are going to benefit, the smaller ones. And of course, and that's why Wells Fargo, for example, has performed much better than the other big banks.